Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Today we're going to walk through what we're seeing in the equity market and the economy in general. Specifically, we're focusing on interest rates, valuations, and where company profits are headed. First, on interest rates. The Federal Reserve has been increasing the Fed funds rate at a faster pace than we've seen in decades. It was 0% back in the first quarter this year, and now it's already up to 3%. And the Fed is guiding towards getting to about 4.5% by early next year. Over the last 12 years, when they've offered this kind of guidance, you tended to take it with a grain of salt because they usually would pivot and start to cut rates as soon as anything bad started to happen in the economy or the stock market. But this time around, we think they will actually get to that 4.5% level because they really are just focused on inflation. We would anticipate seeing the labor market start to weaken in the quarters to come, but data that's been coming through is still showing that the labor market in the U.S. is holding up, which allows the Fed to just focus on fighting inflation rather than worrying about the unemployment rate as well. The Fed Chairman Jerome Powell has also said that he wants to see this rate get above the core inflation rate that he tracks. That core inflation rate, which strips out the impact of energy or food prices, is at 4.5% today and expected to stay about in that range in the months to come. So we think that will provide enough of a tracker for him that he's going to continue to try and move up this Fed rate to that level. The problem is when you have rates moving higher like this, it tends to affect valuations across all sorts of financial assets. This chart looks at Treasury yields from the short end on the left side with as early as 1-month T-bills to on the right side as far out as a 30-year Treasury yield. And the curve on the bottom shows where we were a year ago with rates between 0 to 2%. But now you've got rates anywhere from 3% up to as high as 4.25%. And that affects the valuation for bonds, real estate, whether that's private or publicly traded REITs, and stocks. And what's interesting to us is as much as valuations have come down in stocks, you would expect with rates this high that stocks would have come down even further. But as of right now, we're still sitting at about an average valuation for the S&P 500. Historically, the average is about 16 times. Right now, we're just below that at about 15.5 times. But what's instructive to us is if you're in a drawn-out bear market like what we're in today, you don't typically bottom at a valuation that's around average. You need to see that valuation really start to fall to a significantly lower level, 14 times or below. And that's when you really start to see more panic selling and a valuation that starts to look more attractive for a long-term investor. If you look at past recessions, so in this table here, it shows the last 4 recessionary bear markets we had going back to 1990. You saw that level of capitulation where the low price to earnings ratio was usually somewhere between 11 and 13 times. So if we're still at 15.5, we've probably got a bit further to go, and you need to see a little bit more panic in the market before you start to see those valuations that you'd really like to start thinking a bit more optimistically and aggressively. Besides valuations, the other area we're really focused on is what's going to happen to company profits going into next year. And what we're first seeing is if you look at profit margins, or in this case, free cash flow margins, typically you've seen a rising trend over the last decade, but you're starting to see that shift. And for companies with higher capital expenditures, having to spend more on inventory due to supply chain issues, and seeing their profits starting to pull back, you're actually going to see that free cash flow margin come down by about 1/3 this year, which is very significant compared to the uptrend that we had over the last decade. The sources of margin expansion that we had over the last decade suggest to us that it's going to be difficult to see profit margins expand back to those record highs in the near future. If you look at this table here, you'll see that half of the benefits to manufacturers over the last decade was a decline in interest rates, which now we have interest rates going in the opposite direction. So that's not an available source of margin expansion. Next, tax rates generated 1/4 of those increasing profit margins, but you don't see countries cutting their tax rates right now. And most of the remainder came from benefits of globalization. But whether globalization turns back and goes the other direction or not, we wouldn't expect globalization to increase even further from here. So if you look at all these components over the last 10, 12 years, you don't really see that those are going to be the drivers for future margin expansion, which is going to make it difficult to see this real turnaround here from what we're seeing margins come down to. We're starting to see this on an individual company level with businesses like FedEx and Ford that in the past month have significantly cut their profit guidance for the next year. Investors are still anticipating that profits are going to grow 5% in the second half of this year and 8% next year for the S&P 500. But we expect more announcements like this to happen, first with cyclical businesses and then with even some high quality businesses where you just see a slowdown in their business generation. So here you can see that it's not necessarily baked into share prices or valuations when an announcement like this happens, as FedEx and Ford are both down more than 20% in the last month. High quality businesses are going to see a bit of a slowdown as well, and that's starting to trickle through. So software businesses are fantastic business models. They generate very high margins. They have a lot of visibility to their future revenue because customers pay through subscriptions that they tend to renew over time. So typically this allows a software business, when they report their quarterly earnings and then they give guidance for what to expect for the next quarter, about 9 times out of 10 they're going to offer guidance that's above what investors are expecting. But for the most recent quarter, they offered guidance that was only about 50-50 chance that it was going to be better than expected. So we think this is an area that you're going to start to see this seep through and just cause a slowdown in activity across a range of companies. What this means for our portfolio is that we're going to keep this same cautious allocation that we've had for the past 4 or 5 months. Until we see more of a capitulation by investors and likely a fall off in profit growth expectations, we still think that this decline has further to go. So we're going to continue to own a core group of very high quality businesses with great balance sheets, have a bit invested in an inverse ETF to protect against some of those positions, and then the remainder is just kept in cash and short-term treasuries that are still going to be able to generate a little bit of a yield while we wait for that next great buying opportunity. And we do expect that at the end of all this, there will be a fantastic opportunity for long-term investors. But because this is playing out similarly to what we experienced after the dot-com bubble peak in 2000, as well as from 2007 to 2009, it pays to not be in a rush and feel like you've got to jump in. In this past quarter, we saw the S&P 500 appreciate by 15% in the first half of the quarter and then give it all back in the second half of the quarter. We think that drawn out decline is going to continue until we really start to see more things fall off. We hope that gives you a sense of how we're seeing things in the marketplace today. If you have any questions, please contact us.